infrastructure tends to provide protection in the form of pricing regimes that allow for price increases at a rate linked to inflation. Many subsectors of the asset class allow for this. Some are more direct, so take toll roads, for example. Toll roads, every year they're allowed to raise tolls at a rate linked to inflation. And then you can look at a subsector like utilities. People often think there's not inflation pass-through, but the reality is most utility subsectors go in for rate cases every couple of years. Part of their ask in terms of higher rates to customers include increased costs of their system, increased CapEx on their system. And so in a way, they're incorporating inflationary impacts on their business and on their spending and asking for higher rates to customers. So most infrastructure businesses have very direct linkages to inflation. There are a few that are less direct. So cell tower companies globally, for example, they tend to have what are called revenue escalators. So not exactly linked to inflation explicitly, but they tend to approximate inflation. So 3 to 4% over the long run. There's a number of places where we're seeing value within listed infrastructure, whether it's by subsector or geography. I actually think utilities globally, and in particular in the US, are fairly attractive here, considering our pretty tepid outlook for the global economy. And utilities have dramatically underperformed in this rising rate environment. We think the market's really missing the stability of utility cash flows, the boost that many utilities are getting from renewable investments and energy transition, as regulators and politicians are pushing for increased spending on renewable infrastructure. That is growth driving for these entities. And again, in particular in the US, where we see some real dislocations relative to value. We also like the freight railway space. Again, these tend to be North American plays where you've got listed freight railways. We've been in a freight recession for traditional sort of intermodal freight. These are containers coming off of ships at ports and moving on to railways. They hold things like TVs and the like, consumer goods. We've been in a freight recession, but these companies have spent the better part of the last decade, I'd say, reducing their sensitivity to freight volumes by becoming much more efficient operators. And frankly, their ability to pass through price increases to customers because they have some significant pricing power has been a real save for them because it's offset some of the volume declines that we've seen. From a geographic perspective, I'd say I just noted two subsectors in particular in the US. The US has underperformed a place like Europe, which has been very strong this year. I think the market has been very excited about Europe as it relates to the energy crisis easing from last year. I think the market should take a deeper look at some of the challenges that Europe continues to face from a political perspective, from a productivity perspective, and from a regulatory and political intervention perspective. So we actually, having had some exposure to Europe, and we still have some, but have lessened our exposure to Europe in favor of a place like the US within those subsectors that I mentioned earlier. Canadian Pacific Kansas City is one of our favorite freight railways to own in North America. It is a company that has resulted from the merger of Canadian Pacific and Kansas City Southern. Canadian Pacific was a large freight railway in Canada with operations both in Canada and in the US. Kansas City Southern had a network that spanned both the US and Mexico. So the merger of these two entities creates the only freight railway network in North America that connects Canada through to Mexico. That is a huge strategic advantage. We think there are going to be some tremendous revenue synergies with regard to this transaction. Again, I mentioned earlier, we've seen freight railways become much more efficient over time. So the combination of revenue synergies as well as cost synergies from this transaction should drive some very strong profitability growth for CPKC, as we call it. So we've got a pretty tepid outlook for the US economy. And I think we have to all realize that we have entered a new paradigm as we think about growth, as we're going to be in a below trend growth environment for some time, a higher inflation environment for some time, and a higher interest rate environment for some time. These are things that we have not experienced for quite some time. So I'd say with that comes probably higher market volatility, lower market returns. This is typically a favorable environment for an asset class like infrastructure, which has more defensive characteristics, more the ability to pass through inflation in the form of price increases for many of the businesses. Another note I'd just say on inflation, a lot of folks are talking about the rise and fall of inflation. The reality is, if you look at past inflationary cycles, they've been cycles. They've been long cycles. You've seen ebbs and flows as we think about the ups and downs of inflation. So we expect to see higher inflation volatility. A lot of the inflation we see today is driven by supply constraints, notably in commodities around the world, as you think about producers really just producing as much as they can to keep production flat versus investing for growth in a number of commodities as investors are demanding that. And I think that will continue to constrain supply growth and should keep inflation, again, volatile and high relative to history. So I'd say, we've got the debt ceiling drama right now in the US. We've got an election coming up in the not too distant future. I think we're poised to have some continued volatility in the US equity markets.